You're watching us here on Halftime Report. Good afternoon. I'm Mangla Malu. With me is Ekta Batra. Currently, we're staring at some weakness for our markets. Understandable given the sort of weakness that we saw in the Asian markets itself and the sort of rally that we've seen earlier as well. The good part, however, is that we are holding on to the lows and not falling further. The question that needs to get answered in the second half of trade is whether this dip will be bought into or not, because unlike the previous few days, the mid-cap index at an index level is outperforming, notwithstanding more stocks which are declining than advancing.
Hi, Manglam. Yes, absolutely. And it has died down in terms of global cues as well at this point in time. So maybe there will be just a little bit of a breather. We do have Thanksgiving in the US this week. And hence, the US markets are going to be closed on Thursday. They are working only till 1 p.m. on Friday. So you can see that there is a little bit of softness and dullness which is coming in terms of firm macro cues, at least for the markets at this point in time. But don't worry, we do have the RBI policy, which is in the first week of December. So we will be focusing on that. We have a lot of CPI data from a lot of markets globally this week as well. But nonetheless, let's talk about the first company which is on our radar. Jindal Worldwide is the first company that we're tracking this morning. The stock, in fact, has been buzzing in trade lately. It's up over 87% just in the past 1 year. So it's been quite a rank outperformer. To discuss the company's latest expansion plans and any likely impact of the rupee depreciation and global recession fears, we have with us Gaurav Davra, who's the head of corporate finance and strategic initiatives at Jindal Worldwide. Mr. Davra, hi, welcome to the show. Well, I'm going to start by asking you about demand indicators both in the export markets as well as in the domestic markets. The reason I ask is in the domestic market, we just got done with a big festive season, and the export markets are actually going into the festive season, though you might have already got an indication of demand maybe a couple of months ago. Give us what the demand indicators are from both the markets. Which market are you seeing outperform at this point in time, and the growth estimates as well?
So firstly, thanks for inviting me. Yes, the demand has been, a little soft, both domestically as well as overseas. But as you correctly pointed out, demand is looking up in both the markets. We are going into the festive season overseas, so that is a big boost for the export business, which did take a beating, because of geopolitical concerns and various other factors in the West. And domestically, again, we've, as you said, it's always seasonally a weakish quarter for the textile business, and which is why you would have seen a dampness in the numbers. But having said that, the demand drivers are very, very strong. Cotton seems to have stabilized. Global demand seems to be coming back. Dislocations in supply chains globally have actually eased out considerably, and I think Q3 and Q4 are looking really good, on both fronts.
It's interesting, and that also, I'm presuming, means that you will meet your guidance of 2,300 to 2,400 crore of revenue in this year, with about 31 to 32% contribution from exports. Is that correct?
I think ballpark we should be there. I think the export number may have a little bit of a fluctuation given Q2. But largely we should be on track to do that, yes. With, of course, improving margins as is a recent quarter.
Be able to quantify the fluctuation that you are likely to witness in the export figure?
So I think exports should stabilize around 25% of our top line.
Okay. Give us a sense in terms of the kind of capex which you have coming on stream.
So between current financial year and next, we've planned about a 350 to 400 crore capex, half of which is already reflecting in our numbers. And that is primarily the reason also for the expansion in our margins. As you will see, they're at a 5-year high on the EBITDA and the PAT margins.
So then what are you guiding in terms of margins? Because in Q2 FY23, it was 12.8%. And we all know that there are variables, in terms of what's happening globally. But having said all of that, on a blended basis, what can you guide for?
I think we should be, maintaining the margins between here and a couple of percentage points higher that's safe to assume that we should be able to manage that in the current financial push.
To 15%? Do you go up to 18%? What's a range at least?
No, that's really aggressive. I think 18% is, I mean, we'd be really happy to achieve that, but that's really aggressive for this year. But as I said, having said that, we are at a 5-year high. 12 to 15% is broadly what we have been aiming for. We're, at the bottom end of that. And we hope that we will meet the upper end of that, in this year and next.
All right, take that point. Just before we move on to the other business, you haven't taken further price hikes in the second quarter and now, right?
No, it's been tough actually to take price hikes because cotton has come down. Buyers are delaying purchase decisions, hoping to get a better price in the market if they delay their decisions. So in an environment where raw material prices are coming down, it's really difficult to take price hikes.
Right. And now to the exciting bit, the electric business. And I see that smile on your face. You said that 3 new models will be announced by the end of this year. I mean, how far are you in that? Any sort of order bookings that you can give us a visibility into?
So, yes, that's really an exciting initiative for the group. We hope to commercialize production sometime in Q1 of FY24. You will see our vehicles out on the streets. And we hope to, launch the pre-bookings sometime in Q4 of the current fiscal.
Okay. You had acquired a company some time back, which was, I think, earlier in the in May of 2022. Can you just tell us how that particular company, Earth Energy, is performing at this point in time? Any more acquisitions in the pipeline? What have you set aside in terms of, say, inorganic plans to scale up?
So actually, that was our, platform to launch our EV business. Actually, with that came up, very good talent and a lot of prototypes that have been developed by that team. We're building on what they had already built upon. There's no real major acquisitions in the pipeline. I think we're very focused in what we're offering, and we're hoping to stabilize what we've acquired, build on that, do a commercial launch, and then take it from there.
How much cash or how much capex do you have set aside in terms of, say, investment within the EV space, and what can we expect?
So as I had mentioned last time, I think about, in the immediate future between now and next year, near about 150 odd crores is what we envisage to invest in that business outside of the capex that we have anyway earmarked for our textiles.
And your spinning subsidiary, in which you are, earmarking about 250 crores in terms of investment, I presume this would be a backward integration for you, or would you, sell outside of what you consume as well?
So again, it's opportunistic, but yeah, the primary aim is to become, higher self-sufficiency on the backwards, spinning side. For the simple reason that we are seeing that, given the scale of our business, it's better to have a larger, captive capacity. And as and when required, if seasonality hits us, if demand slowdown, is there, we would like to maintain a good balance. And yes, we will assess, selling to the third party, but primarily it is for captive.
Right. So how much does it cover for your overall consumption, and what does it mean in terms of cost savings? If you could give us some sense of numbers.
Well, I can definitely share with you that in terms of backward integration, we would be at about 60-65% of our spinning requirement post this completion of this, this capex will be captive and in-house, which is a fair, balance to account for any fluctuations in demand going forward. Cost savings is very evident, as you can see. Margins have moved from 8% to 12%. So that's a very clear indication that, at the immediate onset of the first phase of our capex, we're already seeing an expansion in margins, despite, lower revenues and lower pricing because of the global situation. But difficult to put a very specific number on a per meter overall basis. But I think, conservatively, if you see our ROE, ROCs, we're at 20+%, that clearly shows that, getting the capacities in-house is making a lot of economic sense for us.
Okay, we're going to leave it on that note, Gaurav. Thanks very much for joining in and speaking with us. So that is Jindal Worldwide talking about their business. They do expect an up move in margins. They do have an EV arm, electric vehicle arm. So they're looking to commercialize products from that segment too. Interesting in terms of a medley of businesses. That stock down around 1.5%. As we indicated, it's been quite an outperformer this year. Need to take a short break, but up next we'll put the focus on the rollback of export duties on steel and steel products. Stay tuned on that bit of news.
Welcome back. Let's talk about the steel sector. And a boost for the sector, the government has actually rolled back most of the export duties on steel and steel products. Nigel joins in with the details of the same and what it means. Nigel.
Well, that's right. The export duties that were levied in May 2022 have been rolled back for majority of the steel as well as steel products. So for steel, stainless steel as well as pellets, it's been brought down to zilch. While, for iron ore, with the grade of Fe, 58 Fe plus, well, that in fact has been brought down from around 50% to around 30%. There's been a reimposition as well. There was, there was an import duty on coking coal, which was around 2.5%. That's been reimposed out there, so that limits the gains to some extent. What are the probable reasons? Well, in fact, the key reason that they imposed this was to bring down prices, and that was achieved. So that was one factor. The other factor is that demand domestically, well, that's been waning because the export window has been closed out, causing inventory to build up, which in turn could affect the capex plans going ahead. And finally, the trade deficit numbers as well on a month-to-month basis have been looking a little bit sketchy. So this could provide some bit of a boost. Let's analyze the impact then. For steel companies as JSPL, Tata Steel, SAIL, as well as JSW Steel, this reopens that export avenue. However, on pricing, it won't do much because as of now, the domestic prices are at a premium in comparison to imported steel. Moving to the stainless steel players, well, that's a clear benefit for them. JSL Stainless as well as Hisar, both of them are the listed companies. As it is, Europe was grappling with the energy crisis, so that was an that was an opportunity. And earlier, they were exporting close to 25 to 30%, which came down to around 5%. So that opportunity reoccurs. For pellet producers, Godavari Power and Ispat, that's a clear beneficiary out there. They were exporting close to 70% of their produce. They get a chance to do that again, and they get a chance to get better realizations as well. So that one factor, will gain from here on. And on iron ore, NMDC, they don't export any of their iron ore. However, if pellet prices move up, it gives a bit of a base for iron ore prices as well. And that's why, in fact, expect iron ore prices to trend higher. What are brokerages making of it? Well, Jeffrey says that it's unlikely to provide much support to Indian steel prices in the near term. So they continue with their hold rating on Tata and underperform on JSW Steel. Phillip Capital says that it's a positive for the entire space, but that's in the mid to the long term. In the near term, it's not much of a catalyst. And finally, ICICI Securities says that the rollback of duties, well, it's a valuation re-rating event and not an earnings upgrade event out there. So put all these factors together, the stocks reacted. Back to you.
Okay, all right, Nigel. Thanks very much for that. In fact, we did catch up with the management of JSPL and Godavari Power and Ispat to get their view on the rollback of the export duty. Listen in to what the companies had to say.
I must thank the government. And government in its wisdom had put in these duties also to save the domestic industry. It has also seen what has happened to the steel players in the meantime and external markets. And therefore, the government in its wisdom has taken this step, which we welcome.
On the proportion of export, for post duty, the export was practically zero. We were selling everything domestic. And to be honest, I think this is an advance gift by the Honorable Government and Narendra Modi ji, Honorable PM. Going forward, we'll start exploring the export market. And, we usually have an order book about 45 days. So as you correctly mentioned, so we will start looking to exports in the month of January now. We have order books till December for the domestic supply. And from January onwards, we will start exploring the export market.
All right, and we also spoke with Ashish Kejriwal of Nuvama Wealth Management and Amit Dikshit, who's the analyst at ICICI Securities, to decode the impact of this on individual stocks. And this is what they have to say.
This event is more of a, you can say, confidence building rather than numbers upgrade. Reason being is that the duties which have been imposed in May 2022, the situation now has completely changed. And now the world market is not the same what it used to be. So as of now, if I'm looking at from the exports angle, it's still not possible to export HRC because export prices are much lower. That is, export prices are something like 13,000 rupees lower than if you're selling in the domestic market. So exports are not a viable option right now. The only benefit which happened is that this will help them to at least ease some pressure in selling in the domestic market. So that is the only positive thing. And unless until global prices recover, it's not possible for steel prices to increase in that fashion in the domestic market.
There is a very limited scope for flat steel prices going up because we are already at 11 to 12% premium to landed cost of imports. And in that context, I see things getting difficult. I mean, the prices going up would be challenging at this stage. Having said that, there are a couple of areas that one can look at, for instance, stainless steel. So stainless steel exports, I think it gives a big shot in the arm for a company like Jindal Stainless. In terms of if you look the long value chain, so pellet duties have been rolled back. So pellet prices on Saturday itself were up 10 to 12% in Odisha. And I think that would help some of the DRI IF based players like Sham Metallics. And of course, since iron ore prices look to have bottomed out, that could benefit a company like NMDC.
Okay, so that's the view coming in that maybe the withdrawal of the duty is more of a confidence-building move and it probably is not going to impact the earnings trajectory right away. But let's move on from steel and metals onto the entire chemical space, and there's a big deal there. Aarti Industries, which is in fact the largest consumer of nitric acid in India, and Deepak Fertilizers, which is the largest producer of nitric acid in Southeast Asia, have signed a 20-year binding term sheet for the offtake and supply of this particular input, nitric acid. What are the details? Sonal Bhutra is here with us to tell us more.
Yes, Aarti Industries is in focus, so is Deepak Fertilizers. Both these companies have entered into a 20-year binding agreement, and this is for Deepak Fertilizers to supply nitric acid to Aarti Industries. In terms of more details about this, this term sheet is to be executed by end of calendar year 2022, and the total cost here, or the total size of the contract, is around 8,000 crore rupees. Now, to give you some perspective, Aarti Industries is one of the biggest users of nitric acid, and for Deepak Fertilizers, it is one of their biggest product as well. They already had an agreement in place which is getting expired on 1st of April, and that's why the renewal of that contract, but tenure this time is much longer, close to 20 years versus 3 to 4 years earlier. Aarti Industries was already planning to set up a nitric acid plant in order to ensure that there is backward integration and secure their raw material supplies as well, but now they won't be going ahead with it. And they did mention how availability of nitric acid will continue to become a big issue for the company, and now they have secured this. So that is really the impact. The agreement secures supply of nitric acid, which is a big raw material for the company. We spoke to the company earlier in the morning, and they did mention that they now will not be putting up that nitric acid plant that they had earlier planned. The investment in the nitric acid plant was expected between 150 to 200 crore rupees. The overall cost could be around 800 to 1,000 crore rupees. But now that they're not going ahead with it, it will free up the capital for Aarti Industries, and that, of course, is a big positive. And this contract, according to the company, will also enable volume stability and pricing comfort as well. And that's why they are quite positive on this particular contract that they have entered into with Deepak Fertilizers.
All right, so that is about Aarti Industries. In fact, this is our special segment, Insight Edge. So let's get the insight from the man himself, Rajendra V. Gogri. The CMD at the company spoke to us this morning, and this is what he had to say.
In view of overall growing nitric acid demand, we had to put our own plant. We had already announced putting up a concentration plant in month of April. And we are just evaluating whether we put our own WNA plant. That's where this long-term contract discussion started. We will not be putting up that plant now once we have this contract in place. About 150 to 200 crores, but if we had to put the entire integrated plant, it would have costed us 800 to maybe 1,000 crore because of the greenfield plant. The contract really helps us, to get the volume security of nitric acid, also and price stability.
Okay, so that's on the entire chemical space buzzing. Just before we take a break, just watch out for what's happening with the likes of IOB. We've been talking about how the entire PSU banking space has really been one sector which has been outperforming since last week, and that continues into today's trading session as well. IOB, in fact, at a fresh 52-week high. Just to put it into perspective, that stock at one point in time was at 15 rupees in terms of a fresh 52-week low. So huge movement which has come in for Indian Overseas Bank. In fact, that stock has gained around 25% this month itself, a cool 9% gain today for IOB as well. Time for a break now, but Jay Thakkar of Marwadi Shares and Finance will join in with some trading strategies next. Stay tuned.
Well, the first day of the expiry week so far has belonged to the bears. The Nifty is down almost 150 odd points. But for option writers, it doesn't matter whether you are a bull or a bear. They are just looking at the nearest strikes to perhaps, sell those options and make some money before the expiry itself. We're at 18,150. So what it means that the most active options are the 18,200 call. Bears believe that this is their terrain for now. 91 lakh shares or almost a crore shares written at that 18,200 mark for a premium of 80 odd rupees, telling you that levels upwards of 18,250 might face some resistance. Bulls don't want to lose out on some hope. So 18,200 put as well has a few writers, almost 30 lakh shares written on the 18,200 put as well. For those who are deploying the short straddle strategy, the one that we've been talking about here on midday FNO checks every day, the combined premium at the 18,200 call and put together is close to around 170 to 180 odd rupees. So the street is looking at a broader range of 18,000 to 18,400, a more finer range of 18,050 to 18,350 on the way up. 18,050 is an important mark because that also ties in with the technically important 20-day moving average. So between 18,000 and 18,050, there could be some sort of support. That is something that we'll have to watch out for. And it's this support that the bulls are keeping in mind, and as a result of which also going ahead and setting that 18,000 put. So short point for the expiry, 18,000 to 18,050 mark seems to be a bit of a support. But as we go past that 18,250 to 18,300 mark, we continue to face some resistance. If we sustain above that, then maybe there could be a case for further short covering. Whether that ties in with the technicals or not, we have Jay Thakkar of Marwadi Shares and Finance joining us on the show to elaborate upon that itself. Jay, good afternoon.
Very good afternoon to you, Mangalam. And yes, as far as the index is concerned, you rightly pointed out that on the upside, 18,200 on the immediate basis is a clear-cut resistance. I mean, there is where we are seeing good amount of options writing, and on the downside, 18,000 put. That's clearly indicating that that could be a short-term support for the index, at least for a day or two, and hence the range for the index for Nifty, I would say, would be 18,000 to 18,200. And 18,000 technically too, I believe that is a very crucial support, Mangalam, because that is the level beyond which we are not seeing Nifty, in fact, surpassing those levels, 18,000 to 18,100, and post which we saw Nifty, in fact, inching towards the levels of 18,400 plus. Now it's revisiting those levels, retesting those levels, so 18,000 would be crucial to watch out for going forward. Once those levels are tested, I think there at least one can review whether to check for the reversals from down to up. And if all 18,000 levels aren't held, then we can see further pain till the levels of 17,800. As far as the Bank Nifty is concerned, that's a bit that's the index which is a bit resilient, I would say, comparatively, and that's showing some strength at the lower levels. I believe that 42,000 is the immediate support out there. And on the upside, 42,500. I mean, that's a clear-cut resistance as far as the derivatives data is also concerned. So the range for Nifty Bank is 42,000 to 42,500, and mainly we have been seeing that Nifty PSU Bank Index is trading with good amount of momentum, and that's the place where we are seeing good action by the bulls. So I believe that index might trade within this range of 200 points on Nifty and 500 points on the Bank Nifty. And until and unless we don't get a meaningful breakout from this range, we can continue to see this sideways move. Hence, I have one long and one short idea. The short idea is on TVS Motors. I mean, after a long time, I'm actually recommending a short on TVS. It's trading at around the levels of 1,053 on the spot. One can place a stop loss at 1,094 on the upside, and target the levels of 1,003 to 980 on the downside. I think that we are seeing some good unwinding out here on the long side, and the momentum has also weakened, and we have seen a breakdown from an uptrend line support as well. So based on these technical and derivatives parameters, I believe that TVS Motors is likely to see some further profit booking as well. And as far as the longs are concerned, Mangalam, I have a buy recommendation on Hindustan Unilever. After a good amount of correction, I see a good reversal on its momentum indicators, and it has confirmed the breakout from its previous swing resistance as well. So it's trading at around the levels of 25.10. Actual can be bought for a target of 25.60 and thereafter 25.90, and one can place a stop loss at 24.70.
Okay, all right, Jay. We're going to leave it on that note. Thanks very much for joining in and speaking with us. So that's Jay Thakkar talking about the technicals. Just keep your eye out on a couple of these broader market mid-cap pharmaceutical stocks, because Marksons is up around 7% but keep your eye out on something like an Indico Remedies as well, which is gaining for the second day in a row. So that stock is up around 2% to 3% for Indico Remedies as well. That stock should come up for you. Time for a short break, but up next we'll connect with PP Gupta, who's the Managing Director at Techno Electric and Engineering, to discuss their Q2 performance. Stay tuned. Welcome back. Well, it is definitely sluggish for the markets at this point, but the mid-cap index is just about managing to remain flat, while the Nifty is down around 150 odd points, and we have the Sensex, which is shed over 500 odd points at this point in time. So that's what's happening with the markets. But let's talk about a couple of companies then. Techno Electric is the next corporate on our radar this afternoon. The company's Q2 performance was muted, although their order inflow has been quite strong. The company has given, in fact, a 25% compounded annual growth rate revenue guidance for FY24. To discuss more on the company's Q2 performance, their business outlook, we have with us Mr. PP Gupta, who's the Managing Director of the company, joining in. Mr. Gupta, hi. Thank you very much for taking the time out. Well, it seems as though there were some hiccups in your EPC segment this quarter when it came to execution. Can you tell us what went wrong and whether the second half is looking better?
No, the second half is obviously better, as we told almost in the beginning of the year, because most of the orders have been recently bagged by us, and they are all emerging out of the new business verticals. But we are very strongly placed now in new places like transforming place called climate FGD solutions, your data centers, as well as AMI solutions. And of course, we continue to be strong in our transmission systems as it is. So there is a lot of growth in the company. First time we are able to experience order book of 4,000 CR plus. So next 2-3 years, we see very, very strong going forward.
Yes, you have given us, long-term guidance is FY25 revenue of close to around 2,000 odd crores, a lot of money coming in from your transmission, FGD sector, as well as data centers and AMI. Mr. Gupta, I just wanted to understand a couple of things. In the conference call, you did say that Q4 will see, the biggest growth for you in this year itself. The second quarter, your run rate is close to around 230 to 250 odd crores. How much bigger will Q4 be than what you've done in the second quarter as a matter of run rate, quarterly run rate?
I trust Q4 should be at least no less than 500 CR or more. It will be all-time high because of the pressure of timelines to achieve in these projects. And similarly, Q3 will be quite good compared to Q1 or Q2.
So that means that your annual revenue can surpass your earlier guidance of 1,250 to 1,300 crores?
No. I think we like to stay with 1,200, 1,250 guidance as well as this year is concerned. But next year, definitely, we can expect another growth of 25% on it.
Okay. Can you just tell us about what is taking place with regards to power supply, cost of power? You have spoken about that as being a concern. What might you guide us for when it comes to the second half?
See, basically, we are only a small generator in Tamil Nadu in wind power, where we have a capacity of 130 megawatt. And definitely we see going forward that power costs are going to be more and more affordable with the renewable power penetration, and we are able to generate now renewable power at 0.8 or 0.7 of conventional power, unlike 10 years back when it used to be 2-3 times. So we see these transformations happening in energy space strongly from conventional power to renewable power space, and related opportunities to it, like green corridors and a lot of AMI work and downstream strengthening of distributions, because government wants strongly distribution reforms, power losses, financial health of discoms. All that is on the card now. Additionally, we are also focusing on data centers, which we believe is a multi-layered power solution, power guzzling solution, which is within our forte. And we see a good traction in that area also. So all put together like AMI, FGD, and data centers, along with your conventional ability to deliver most complex or any high-end solutions in transmission. I think the time has come to harness the potential of this company, which we really missed for the last 2-3 years because of COVID, elections, and related issues.
Right. Could you give us a few more details about, your order intake for this year? You said that it could cross 4,000 crores. How much will come from transmission? How much of it will come from FGD and data centers, etc.? Because your current order book does not even include your own in-house orders of close to around 1,250 odd crores. So if you add that back, what does your total order book look like?
See, already the order book as reflected is without our in-house orders like data centers. If you add that, we are already 5,000 CR plus. But without that, also today we are at 4,000 CR, because today only we received the AMI order of another 350 CR where we were L1. And we also received the order for Goa, which we announced in the revenue. In this quarter, it happens to be from Starlight.
Okay, just quickly before we let you go, Mr. Gupta, I just wanted to understand the receivables position when it comes to projects such as in Afghanistan, because we've heard, some mixed reviews. While some companies have managed to see some progress when it comes to receivables, others haven't. So what is the outstanding and what is the progress?
So our outstanding is about 45 crore, and we definitely don't see any traction. And I doubt any company has received any money from Afghanistan, because the money has to come from World Bank and ADB, who have not reinstated their loans. And they cannot happen unless politically US recognizes the present government. So there are some challenges, although DABS is approaching us to resume the work, promising many things, but we trust unless loans are reinstated by these global lending bodies, there cannot be sustainable completion of the project. But we are relatively better placed than many others, because 80% of the order value stands executed. And this is a Central Asia project, not limited to Afghanistan. So we are very hopeful that whenever the things gets going, this will be the first project to be taken up by the lenders.
Okay, all right. We're going to leave it on that note, Mr. Gupta. Thank you very much for talking to us. So that's Techno Electric, quite bullish in terms of an order book going forward. So they're expecting it to probably scale up to at least incremental order inflow in terms of visibility that they have at over 1,000 odd crores. We'll take a short break. On the other side, we'll put the focus on HUL and Escorts, which both held analyst meets. So we'll tell you what they're telling investors on the other side. Stay tuned.
झाके रे झाके झरोखे से झाके हैरत से आंखें अपनी सी दुनिया नई रंगी लागे ख्यालों की खिड़की
Reimagineering brighter futures with smarter steels. ArcelorMittal Nippon Steel India. Smarter steels, brighter futures.
आग को फैलने से रोकना मुश्किल है पर नामुमकिन नहीं। अब फायरवॉल टेक्नोलॉजी के साथ सेंचुरी प्लाई क्लब प्राइम आग से बचाए।
गुणवत्ता की बात चली है, एक नई शुरुआत मिली है, परिवर्तन को गले लगाकर अपनाएंगे जेड। प्रोडक्शन भरपूर बढ़ेगा, प्रॉफिट भी अब खूब चढ़ेगा, काम को नई दिशा दिखाकर अपनाएंगे जेड। चलो देश का रूप निखारें, पर्यावरण को हम ही संवारें, प्रदूषण से बचाने को अपनाएंगे।
Register with Ministry of MSME's SET certification scheme today and help India become a global manufacturing hub.
This tax season, invest in Samco ELSS Tax Saver Fund that aims to create wealth for you by investing in high-quality small and mid-sized Indian companies. And the best part, also saves tax with ELSS. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Play it your way. Play it your way, your way.
Sarah, this is your space.
Play it your way.
With the versatile range of sanitary ware, faucets and tiles by Sarah.
Welcome back. Well, it is the season of holding a lot of analyst meets, considering that Q2 earnings season is over. We had Glenmark, Glenlife last week. We have a couple this last week as well, the likes of HUL on Friday and Escorts as well. Let's start with HUL, the Nifty company. Mangalam, what were the key takeaways?
The key takeaways is that their analyst meet happened for the first time in person after 3 years because of the pandemic, etc.
Yeah.
So stock at the high point of trade because the companies reiterated their focus. Market leaders in more than 85% of their categories. Digital is now 25% of their demand and 33% of their portfolio is premium, which is much higher than what it was a few years ago. Market development sales that the companies made actually contributed over 10,000 crores to their overall revenues, and now they are owners of 16 brands which have crossed the 1,000 crore mark in terms of revenue. In terms of hair care, their market share is the highest in the last 2 decades because they've gained 400 basis points in terms of market shares in the last 3 years itself. Liquid wash, which is a premium category, has crossed 2,000 crores in terms of revenue, but still the penetration is just 10%, so that signifies the potential that there is. And the most important thing that everyone was looking at in the HFD, health food drinks category, the penetration for Horlicks, etc., has increased by 200 basis points, and as has their physical reach. So as that increases further, there is only a case for better margins. What do the brokerages make of this meet? Jeffrey says that tech is at the heart of everything that the company is doing, and the second half we should see gross margins recover. They have a buy target with a target price over 3,000. Philip Cap says that it has the best execution capabilities in class, high conviction target price of 3,200, and premiumization continues to be the order of the day, says ICICI Securities. So that's brokerages by and large being happy. But Escorts is the other one which is surging today. Sonia, the analyst meet went well.
Oh, it did. And, the thing is that Escorts has now laid out a medium-term business plan for the company. And that's something that the street has really liked because it's quite aggressive, the targets that they have. They spoke about more than doubling of their revenues by FY28 over FY22. And they also spoke about margins in mid-teens, versus 10.8% in FY22. And now, they're looking to gain market share both as far as exports as well as the domestic market are concerned. They want to attain leadership in the export of tractors and in the domestic market from the 10.8% market share currently. They're looking to be a challenging brand. How do they plan to achieve all of this? By raising their capacity. So there's a huge capex plan being put on board. They're looking to expand capacity to 300,000 units from 170,000 earlier. And the total capex that they have outlined is about 3,500 to 4,000 crores. So the plan looks very ambitious, but here's the thing, the stock has rallied quite a bit as well. So JP Morgan remains underweight on the stock. They say that yes, it's a very ambitious and positive growth plan, but a lot of it perhaps is in the price because the stock is now trading at 25 times forward PE and has priced in not just this good news but also the strong growth. So just some amount of caution at higher levels, but that has not stopped the stock. It's up 6.5% in trade. Back to you.
Okay, all right, Sonia, as well as Mangalam, thanks very much for that. So a lot of these stocks in focus on account of analyst meets. Time for a break now. On the other side, our commodity segment. Manisha.
Welcome back to Halftime Report. Let's talk about the sowing numbers now. And Rabi is one of the major crops that is within the Rabi is wheat. And we've seen the sowing numbers increase almost by 15%. Not a surprise there really, because in this year we've seen the prices gain up by almost 2% is the reason that the government had to ban exports. And the buffer stock with the government also is nearly half of what they had last year. Siraj Hussain is former Agriculture Secretary and he also joins us now on the show. Mr. Hussain, hi, welcome. How do you look at the overall sowing numbers up by nearly 8% as compared to previous year and the kind of sowing that wheat clearly has seen go on?
Sowing numbers are very encouraging. I think the farmers have taken into account the loss to wheat crop last year and the possibility of a lower paddy crop. The farmers would have also noticed that the wheat inflation is about 18% year-to-year inflation, and even in case of rice, it is touching 10%. So they would be hoping to realize better prices, and that is why we see good numbers of sown area under wheat higher than last year.
Clearly, a bit of a disappointment clearly seen in case of the pulses. But then again, last year did not see pulses prices move too much. We've seen many of the pulses prices actually at or below MSP as well. And that clearly shows into the number there. I mean, I agree, these are still early days and you've said that to us already. But do you think that this is one area where it could surprise us on the lower side at the end of it?
I would not be surprised if the area under chana is lower than last year. And the reason is that the chana prices have almost consistently remained below MSP for about a year. The future trading of chana is banned. When the new Rabi crop came in March, April, the chana prices were lower than MSP. And there is uncertainty whether the ban on future trading will be lifted or not. So I think we may well see area under chana going down.
You mentioned about the futures ban, Mr. Hussain, and that deadline of SEBI's 1 year expires on 20th of Jan 2022. That would be exactly 1 year since many of those, or rather 7 of the agriculture commodities were banned for derivatives trading. What's your sense? The government has been meeting people. There has been a CDAC meeting on that as well. Do you think it's time now, given the kind of volatility that we've seen in many of these commodities, for this trade to come back?
I, for one, would hope that ban on several of these commodities will be lifted. But I do not know whether the decision-making is preceded by wide enough consultations. So I don't really know. But I think the government has already received information from various quarters, and I think they would be distilling that information and coming to a decision very soon.
All right, that's a hopeful thing to look at. But just coming back to the numbers then, and when you look at the Rabi sowing, another encouraging number really comes in from the oilseeds area, up by 12.8% as compared to the previous year. Mustard is up 14.7% as well. So within oilseed, actually, mustard seems to be doing the best.
Actually, farmers would be expecting good price of mustard because last 1 year, especially after the Russian invasion of Ukraine, we have seen very high prices of edible oils, especially in the beginning, that is February, March and April. So the farmers would be expecting a very good price of mustard. The new varieties introduced by various companies like Corteva, etc., also seems to be very encouraging. They are working in the field with the farmers and they claim that their hybrids are giving 15 to 20% higher productivity. However, I must say, especially in the light of discussions in the last 2 weeks on climate change, that we can only hope that the temperature will stay low, because wheat plants require 14 to 15 degrees of optimum temperature at the time of ripening. And if the temperatures are higher, as they were last year in the month of March, then the crop loss will be very disturbing this year.
And, it's not just about pulses where we have seen the sowing decline by 3.7%. The lentils number does not look so good as well, down 7.5%. Core cereal sowing is down by 2.8% as well. I mean, the PM also seems to be talking about lentils a lot, and there has been a lentil mission that we were reading about too. So when you look at lentils, pulses, core cereals, what's your sense here?
Actually, and I've been writing about it, that the landed cost of these commodities should not be lower than the MSP. And the government should protect the MSP by fine-tuning the landed cost by, adjusting the import tariff from time to time. So one reason why the lentil prices are lower is the import parity, due to which imports have been coming. Also, we have signed agreement with some countries. So I'm hoping that the government will be more agile, and the tariffs will be adjusted from time to time, and the MSP will be protected so that the farmers are incentivized to grow pulses, especially lentils and chana.
So some measures need to be taken there, but no surprises really here, because we are looking at oilseeds, rice and wheat sowing numbers on the higher side, and the prices have been higher, and the kind of measures that the government has taken clearly has led to farmers onto these things. Thank you, Mr. Hussain, so much for joining us with your analysis on those sowing numbers. With that, it's a wrap on Halftime Report. Business Lunch will take all the action ahead.